Welcome, Anders. We're very happy to have you in the studio this morning. Earlier this morning, you were meeting with our investment teams and noting that despite a lot of the dramatic news flow and heightened geopolitical tensions, that markets remain rather resilient. That we've had the S&P is still at a high level, we still have an elevated 10-year yield, and that the oil is trading still at a constructive $64 per barrel. Even if the winds at the top are blowing and markets are still holding on to some kind of resilience, can you break this down for us?
Well, I think the first point to make is that over the last 3 decades, geopolitical worries have had a limited market impact. The main fundamental reason for this is that oil doesn't play the role it did in the 70s and 80s, partly because US is now self-sufficient in oil production, and the Hormuz Strait has become more of a problem for China and Asia than it is for Europe or US. I don't think we can reconstruct a logic that makes Mr. President Trump predictable. I don't think we can do that. We can spend hours on it, but he will remain unpredictable. There are no logical reasons for him to go after Greenland. The mineral resources will not come to the market within, it probably takes definitely more than 1 decade and probably even longer. If the worries are the North Passage for Murmansk fleet and China, that could probably be solved without this great conflict with Denmark, and it's a bit the same with Venezuela. It is not a strategically important oil reserve, and if the US wants to block oil export to China, they could do it anyway. The more logical thing for Trump to do would be to focus on Iran, because that's the Hormuz Strait. And we haven't seen that play out fully, I think, yet. There could still happen further developments. But why he's going after Greenland, I think, is very, very difficult to make sense out of. To my mind, there are a couple of strategic points that has held him back. The 10-year bond seems to be very important for him, and it went up a bit, and that calmed him down. The S&P 500 dropped back a bit. Besant came out and tried to take a deep sigh and pause and think of what is happening and what will happening, was the comment from Besant. So I don't think we could kind of predict Trump, but it seems like he's backing down when the markets are pushing him. I think it's also very relevant to note that tariffs are not a major macroeconomic factor. The impact from what we've seen so far is probably a couple of tenths of percentage point inflation in 25 and probably a bit less in 26. I did rerun these 10% tariffs in my macro model, and if you look at the Nordics or Germany or France that would be affected, we're talking about a tenth of a percentage point on growth and roughly the same on inflation. So I don't think that's a factor that we should pay too much attention to. Tariffs can have an impact. There are a couple of items where prices has gone up, like toys, furniture, and T-shirts and the like. I think that is basically a problem for Trump because he's coming towards the midterm election, and the voters don't like inflation. So I mean, the tariff weapon is there, but it can easily backfire on Trump. And there is absolutely no support among the US public opinion for a military expedition against Greenland, not even among the Republicans. So this is not the game to win the midterm. So yeah, I think we just have to accept that Trump is unpredictable. We can feel a bit reassured that geopolitics really haven't played that role that it did in the 70s and 80s in the last decades. And Trump seems to be backing down when the markets are coming at him. So maybe therefore we should kind of focus more on the fundamentals than this geopolitical noise. And I don't think that European leaders can really do anything. Europe is a middle power. We don't have a strategic alternative to the US. But on the other hand, the main threat for Europe is Russia, and Russia is definitely a middle power. It's not a superpower anymore. China is not, they have their own geopolitical focus, and it's not directed strategically against Europe. So yeah, I think the Europeans do what they can. They try to mitigate, and I think it's been wise that they've refrained from emotional reactions like starting a trade war and bringing out bazookas and whatnot, because that would basically harm European consumers and basically harm the European economy. We don't really have margins on to maneuver there. Europe is in perma stagnation, and we don't need any tariffs that pushes growth below a percentage point or so in Germany, France, or Italy. So yeah, a bit reassuring, and it's easier to say this today after Trump backed down. But I think the main conclusion is that we just have to accept that he is not a very rational actor, and hope that the stock market and the 10-year can keep it under control also going forward.
If we turn a little bit more to just the US economy, we have quarter reports coming out, Q4 reports coming out now, starting with the banks, but the bigger IT names starting to come during next week. How is the US economy doing, and what do you expect for the fourth quarter reports?
No, that's a very important week we have ahead of us. If we are getting almost all the big tech names, Microsoft, Amazon, Apple, and also Alphabet. If they are able to deliver close to where they were in Q3, where we had earnings per share growth between 25 and 30%, I think that's a reassuring factor. It's also very important in terms of macroeconomics. Roughly half of US growth in 25 was driven by AI capex. If you combine the big companies and also the medium-sized tech companies and then add AI infrastructure, potentially we could see AI capex this year between $1.5 trillion and $1.5 trillion US dollars. That would probably push US growth closer up to 3%, which would obviously be important for the stock market, but also in general terms. I remain optimistic on the tech companies' ability to deliver profitability. They have, on average, very high EBITDA margins, and it seems like there is a potential that AI investments actually could deliver a bit more. There is a lot of talk about the AI bubble. I think that is a bit misdirected. I'm more worried by the fact that Europe doesn't have any leading AI names, that Europe is lagging behind in AI implementation compared to the US and China, but that Europe is so strong and has a real dominance on the legacy industry, the industries that will be disrupted by the creative destruction that AI brings. So I think the downside risk is probably bigger and more on the medium-term perspective, and that's not the valuation of a few stock companies. It is the fact that Europe is lagging behind in the crucial technological frontline, and also obviously then is lagging behind in terms of productivity and growth. So I think we are focusing a bit too much on PE numbers and focusing not enough on the fact that Europe is lagging behind, not only in innovation, but also implementation and production, where China and the US are very much ahead of European Union.
If we stay on AI there for a moment, that's been a very hot topic at the World Economic Forum now in Davos, with a lot of shifting from talking about AI hype to talking about AI results. What are you taking from the highlights and the discussions that are ongoing and will be ongoing for the next few days? Well,
I think the best AI investments that I see are the ones that are directed towards cost cutting, reducing cost for IT departments, using AI as a programming tool, and then rolling that out to accounting, HR, and other business administration. And I think the potential there is pretty high. So I do think that there is a potential that productivity in the US is accelerating during 26-27, and that we eventually see a bit of this also in Europe, but Europe clearly lagging behind. There is a labor market implication. Wall Street Journal talks about the Jobageddon. It is mainly fairly well-educated white-collar labor force that could be impacted. Normally, higher education and better connectivity to the labor market implies that it will be less problematic from a labor market perspective, but it could kind of dampen wage growth and maybe lead to somewhat higher unemployment in the US. So yeah, there is a job-ageddon, and that could bring inflation down. So we could have a capex-led expansion in the US with pretty good results on productivity, and that could bring kind of a couple of pretty decent years in the US economy.
At East Capital, we've looked at the outlook for 2026 as having a very strong investment case for emerging markets. How does all of this impact emerging markets going forward now?
Yeah, I obviously agree. Clearly, countries like India, China, Indonesia, Vietnam has a much higher nominal growth, not only this year, but also for the next decade. That gives a strong, solid footing for their sales outlook. And historically, the margins has actually been pretty decent in these markets, partly because the companies that are listed tends to be on the forefront on the technology and therefore running better productivity numbers. There is also a bit of momentum now because the valuations are a bit suppressed compared to the US, and the growth outlook is obviously much better than Europe. So you get the European PE number, but the growth numbers that is much higher. So yeah, I think it is a bit of a opportunity now when it comes to China, the rest of Asia, in terms of stock valuation. And if you don't think in the short term and take a longer perspective, I think the case is actually even stronger, because you have the long-term growth, you have the high margins, and there is also I think a good solid case for risk premium coming down over the next couple of years, given that governance is improving, transparency in the markets are improving. There is a lot of retail interest in these countries for the stock market. So I think there is a pretty strong case for emerging market and frontier markets right now.
The other case that we've talked a lot about has been in times of volatility, the strength of the Nordics. What do you see for the Nordics?
Yeah, I mean, obviously there is a Nordic light in the European economy. The Nordic countries are growing faster. Inflation is under better control. Currencies and productivity has created a very strong position in terms of competitiveness. I do think with the development that I foresee in the global economy, the industrial export companies are actually going to have a bit of a rebound. So I do think that there is a pretty strong case for the Nordic stock markets, and I would actually add that I think the Swedish one is very attractive at the moment.
Thank you very much for that update. Anything else on the horizon that you're specifically watching?
So I stick to my view that if you're into equity, you need to spend your time on evaluating the companies. Macro is a side restriction, and geopolitics often becomes a noise that disturbs your thinking. So stick to doing your job, find the right companies with strong growth, strong moats, and good valuations, and try to have that as the key focus.
Great advice. Thank you very much for today.
Thank you very much.